Hi students, in the last video of section E, we have seen corporate governance and the related matters. As a continuation of that, in this one we are going to see internal controls. If you see the Hawk International materials, governance principles, hierarchy of corporate governance, we have seen in the first video. This video, introduction to internal controls, transaction controls, safeguarding controls. Let's look at these three. So out of 10 chapters or 10 units, we will see 3, 4, 5 in this video. Definition of internal control. According to COSO publication, internal control, how they define that? Internal control is a process effected by an entity's board of directors, management, and other personnel designed to provide reasonable assurance. There you go. This is the important part. Reasonable assurance regarding the achievement of objectives relating to operations, reporting, and compliance. So, one word I want to highlight here, it doesn't give you absolute assurance. Having a proper internal control system doesn't 100% ensure that objectives are achieved. It gives a reasonable assurance. Reasonable, 80-90%, you can say reasonable, not 100%. So, thus, internal control is a process that is carried out by an entity's board of directors, management, and other personnel that is designed to provide reasonable assurance that the objectives are achieved. Objectives of the internal controls provide reasonable assurance that three things will be achieved. First one, effectiveness and efficiency of operations. What is effectiveness? Achieving the expected outcomes. Right? You have some objectives, you want to achieve something. Achieving them is what you call effectiveness. Efficiency means achieving with less input. Achieving the expected outcomes with minimal input. You say efficiency. Second one, reliability of financial reporting, internal and external, both. Compliance with applicable laws and regulations. First one, effectiveness and efficiency of operations. Second one, reliability of financial reporting. Third one, compliance with applicable laws and regulations. Fundamental concepts. Definition of internal control reflects several fundamental concepts as follows. First one, the purpose of internal control is to help the company achieve its objectives. We saw that in the definition also. Internal control is an ongoing process, meaning throughout the year, every year it happens. Not something like you do once and then forget it. No, it's an ongoing process. Internal control is affected by people. So the decisions made, policies, procedures, everything are implemented by people. Internal control procedures can provide reasonable assurance only. This was also there in the definition. It doesn't give absolute assurance. It gives reasonable assurance. Internal control must be flexible in order to be adaptable to the entity's structure. For example, an entity might start as a small organization. It might grow, it might become bigger, it may have multiple branches, it may have multiple products, multiple divisions, multiple functions. So, when the organization grows, accordingly, the internal control department also will have to be modified. The internal control procedures will have to be modified depending on entity structure. So, that is what they say. It must be adaptable to the entity's structure. Reasonable assurance. An internal control system cannot provide absolute assurance. Repeatedly, we are highlighting this point. It provides only reasonable assurance that management and the board of directors are made aware in a timely manner about the progress towards achieving objectives. Who is interested in the internal controls of a company? There are a number of diverse parties that are interested. Obviously, investors, because they are the ones who have invested the money. So they want to see whether operations are happening effectively, efficiently. Second one, external auditors. Why external auditors? If the internal control function has been working effectively, External auditors can base some of their workings on the internal control system's output. If the internal control is reliable, they can take it as the starting point for their work, external auditors. Legislative and regulatory bodies, to ensure that the company complies with all the laws and regulations. Management, they use the information for making decisions. So the internal control system has to ensure the reporting, internal reporting is happening accurately. Customers, why? There are many things. One, I can say, if the internal control system is happening properly, if it is functioning properly, the efficiency will be good. That means the wastages, idle times, everything will be reduced. End of the day, it's going to reduce the cost of the product, which is finally passed on to the customer. So customers also may benefit from internal controls. COSO define the responsibility to maintain and address internal controls as follows. The board of directors is responsible for overseeing the internal control system. Who is ultimately responsible? Ultimate responsible is with the CEO. The CEO is ultimately responsible for internal control system and the tone at the top. However, board of directors have a responsibility to oversee whether the internal control system is functioning properly. Senior managers delegate responsibility for establishment of specific internal control policies and procedures to personnel responsible for each unit functions. For example, finance department, HR department, production department, procurement department. Every department will have certain policies and procedures defined by internal control divisions. So senior managers like CEO, CFO, they will pass on the responsibility of implementing these internal controls to the departmental managers, the junior managers. Who is responsible for internal control? Financial officers and their staff are central to the exercise of control. Exercising. So, main point you need to remember, ultimate responsibility is with the CEO. Board also has a responsibility to oversee the process. The rest is just for your reading. Internal auditors play a monitoring role by evaluating the effectiveness of the internal controls. Virtually all employees are involved in internal controls. That's the point. It's not only the top management, it's not only the internal control department. Everyone is involved. So it's a summary which we have already seen. Components of internal control. There are 5 components. COSO lists 5 interrelated components that make up internal control. First one, the control environment. Second one, risk assessment. We are going to see them one by one. Third one, control activities. Fourth one, information and communication. Fifth one, monitoring. Remember this list. Sometimes you can get basic questions like which of the following are included in the components of internal control by COSO. By the way, I have been using this term COSO from the beginning. What is COSO? Committee of Sponsoring Organization. This is the expansion of COSO, Committee of Sponsoring Organization. Principles of internal controls. There are 17 principles of internal controls that are embedded in the 5 components. So within these 5 components, they have mapped 17 principles. Let's see one by one. Component 1, control environment. This is the most important element of internal controls because it is the basis on which the elements are built. So what is control environment? The people, the machines, the computers, everything used in the company, you can call control environment, because at the end of the day, you're going to apply, you're going to implement the internal control policies and procedures on these people, on these machines, on these computers. So people, machines, computers, softwares used, all of them, you say control environment. Factors that influence the scope and effectiveness of control environment include integrity and ethical values of the entity's people. How people see ethics, how they value ethics. Integrity means how straightforward, how honest people are. A commitment to competence, whether they are thriving to become competitive, to be competent. The attention and direction provided by the board of directors and audit committee. Management's philosophy and operating style. Some organizations are informal, some are formal. So all this will matter. Company's organizational structure, the way management assigns authority and responsibility for operating activities, human resource policies and practices. So these are all basically how people behave within the company. Right? This is what you call control environment. Internal controls are more likely to function well if management believes that the controls are important and communicates that support to all employees. They must set a positive tone at the top. See, there are organizations sometimes, they may have policies, well drafted policies, but it's only in the papers. Practically, half of the policies are not even known to the employees. They never implement those policies. So here, management is doing a bigger mistake by taking the policies, procedures too easy and not taking it seriously. So this is the wrong tone, negative tone set by the management. Whereas positive tone means the management must take it serious. The management shows commitment to, implement the policies. So this is what they mean by they must set a positive tone at the top. They do this by transmitting guidance both verbally and by example, communicating the entity's values and code of conduct, fostering a control consciousness by setting formal and clearly communicated policies and procedures, specifying the competence level needed for particular jobs and delegating authority accordingly, working closely with the board of directors who help ensure the company is operating the best interest of the shareholders. Control environments principles. Remember, we said there are 5 components and 17 principles. These 17 principles are mapped into the components. So within the first component, we have these 5 principles. First one, the company demonstrates a commitment to integrity and ethical values, corporate culture. Second one, board of directors demonstrate independence from management and exercise oversight over internal controls. Board of directors must oversee, supervise the internal controls. They must give the guidance for internal controls. With board of directors oversight, management establishes the structures, reporting lines and authorities and responsibilities. The organization demonstrates a commitment to attract, develop and retain competent individuals in alignment with objectives. The organization holds individuals accountable for their internal control responsibilities in pursuit of objectives. So these 5 principles are coming under the control environment. So basically, as I told at the beginning, the people, how serious they are about ethics, governance, internal controls, policies, procedures. So this is what you call control environment. Component 2, risk assessment. Once the company objectives are defined, risk identification can begin. Risks can exist at the entity level or activity level. Entity level means the risks that affect the whole organization. Something like that affects the reputation of the company. Activity level means specific to each division, like procurement department. Some frauds might happen. Storage, there might be fire accidents or risk of theft in the storage. So these are activity level risks. Something that happens to the whole organization is the entity level risk. Risks can be both internal and external. Internal, like the examples I said now, theft, fraud, fire accidents, not following the policies and because of that facing issues. Internal. External, competition, government policies, economic conditions, external factors. After the company has identified its entity level and activity level risks, it should perform a risk analysis to estimate the significance of each risk, how big, how bad the impact could be if this risk is materialized. To assess the likelihood or frequency of each risk occurring. What is the probability? Likelihood means probability. What is the chance that this thing can happen? These are the 2 key factors that we use to analyze the risks. One is the significance of impact, how big the impact is. to the chance of it happening. To consider how each risk should be managed by assessing what actions need to be taken. So under risk assessment, component 2, what are the principles we are getting? Can you see 6, 7, 8, 9? 4 principles are there. Out of 17 principles, 5 of them were in component 1, 4 of them are here. Company objectives must be specified clearly enough so that risks to objectives can be assessed. Operations objectives, reporting objectives, compliance objectives. So basically the objectives have to be clearly defined. Then only the risks to those objectives can be assessed. The organization identifies risks to the achievement of its objectives and analyzes them to determine how to manage them. Internal risk, external risk, transaction level risk, risk analysis. Risk analysis we will see again later, I think, not now. So the likelihood and impact diagram we will see. Sometimes we call it heat map. Risk analysis heat map we will see in a while. The organization considers the potential for fraud in assessing the risks to the achievement of objectives. The organization identifies and assesses changes that could impact the organization's system of internal controls. So all these principles, you don't have to memorize these principles, just read and understand, that's enough. But the components, 5 components, you need to remember the names. Component 3, control activities. So now you have done the risk assessment. See, first one we said control environment, defining the control environment. Then identifying the risks. Third one, control activities. That means what you are going to do to mitigate or minimize these risks. After the risks have been assessed, control should be designed to limit the risk. To accomplish this, control activities are implemented. These activities are the policies that are developed to address the risks of the company. The procedures that ensure the policies will be followed. So basically, how you are going to handle those risks. Any control implemented must have a benefit that is greater than the cost of that control. Obviously, any activity we do, there is a cost to that activity, but the benefit we get from that activity must be more than that cost. Because of this point, not all controls are implemented. Sometimes there might be small risks, but to control that, the measure you have to take might be too expensive. So in that cases, it's okay just to leave that risk, unmanaged, let it go. So there are some principles under this as well. 10, 11, 12. There are 3. Organization selects and develops control activities that contribute to mitigating risks. Preventive, detective, segregation of duties. Preventive means attempt to prevent the mistake. That means sometimes we give training to the employees. Why? To ensure they don't make errors. They don't make mistakes in handling the machine. Sometimes we do, not sometimes, always we do maintenance of machines before it breaks down. Routine maintenance. Why do we do routine maintenance? To make sure that the machines don't break down. They function properly. So these are known as preventive controls. Detective controls, to identify if there are any risks, to identify whether any breaches have happened, like supervision, fixing some sensors, cameras. See, these are all detective controls. Segregation of duties where possible. That means we shouldn't assign all the tasks to one individual. For example, say a company that involves in sales, a department that involves in sales. Cash collection should be one person. That means following up with the customer and collecting cash must be one person. But invoicing must be a different person. And then accounting and banking should be another person. Then the risks of mishandling those funds can be reduced because there are many people involved. The person invoicing is different, collecting cash is different, accounting for it is different. So that's the meaning of segregation of duties. Purchasing manager, or the person who initiates the purchasing order, and the person who authorizes the purchase order cannot be the same. It should be different people. Why? So it reduces the chances of fraud. The organization selects and develops general controls over technology. The organization deploys control activities by developing policies that establish what is expected. So basically, all these principles are about developing control measures to handle, to deal with the identified risks. Examples of control activities: top level reviews. Reviews means, checking the files, checking the activities, supervision. Direct functional or activity management. This is the direct supervision. Information processing, preparing reports, time to time checking the reports. Independent checks like audit, internal audits. Performance indicators. Physical controls to safeguard assets. Physical controls means certain assets you keep it in the locked places where not everyone has access. Documents and records. Authorization, like I said, purchase. One person initiates the purchase order, another person has to approve it. Authorization. Segregation of duties, I already explained. So these are some examples of control activities. Segregation of duties, again we have duties need to be divided among various employees to reduce the risk of errors or inappropriate activities. No single individual should have enough responsibility to be in a position to both perpetrate and conceal irregularities. Do you understand? Like there must be a couple of people involved. Still, it doesn't eliminate the chance of fraud. It reduces the chance of fraud. Why I say it doesn't eliminate? Now, if 2-3 people, like one is initiating the document, another one has to approve. Now, if a fraud has to happen, both of them have to get together and do it. So it reduces the chances. Duties to segregate. Different people must always perform the following 4 functions. Authorizing a transaction should be one person. Recording the transaction, preparing source documents, maintaining journals, another person. Keeping physical custody of the related asset, another person. The periodic reconciliation of the physical assets to the recorded amounts. That means if it is inventory, counting the inventory and comparing that with the records must be another person. None of these people. So these 4 must be done by 4 different people. In materials, a large list of what duties people have. More practical than exam based. But anyway, for your exam, remember these 4. Authorizing the transaction, recording the transaction, keeping physical custody of the asset, and periodic reconciliation. 4 different people should do. Already I explained segregation is not a guarantee. It doesn't give absolute assurance. It gives a reasonable assurance. 4th component. So what was 3rd component? Control measures. 4th one, information and communication. Information needs to be obtained from and communicated to people to allow them to perform their duties. So basically reports, budgets, variance reports, annual reports, monthly reports, cash flow reports. Reports have to be generated. Communication must be ongoing. Yeah, regularly it happens. Duties and responsibilities need to be communicated to all affected parties so that they are able to communicate significant information upstream. That means if they have to inform something to the top management, they will do it. Reports containing operational, financial, and compliance information must be available for informed decisions. Some information must be communicated to those outside the organization and must also be available from external sources. And these are general reading, nothing much you have to remember or memorize from this. And there are a couple of principles. 3 principles are there: 13, 14, 15. Organization should obtain or generate and use relevant quality information to support the functioning of other components. The organization should communicate internally for information, including objectives and responsibilities. The organization should communicate with external parties the information. So that's basic reading, nothing much in that. Last component, monitoring activities. Monitoring is the process of reviewing controls over time. See, you analyze the risk, you implemented the control measures, And then you are generating reports to check, to go through. Now, we need to check whether the control measures that we implemented are good. The risks that we identified, does it cover all the risks? Did we miss anything? So time to time, we have to review our whole process, whether everything is happening effectively. Monitoring is the process of reviewing the controls over time to make sure that they are still relevant and still functioning as they were intended. And there are a couple of principles. The organization selects, develops, and performs ongoing or separate evaluations to ascertain whether the components of internal control are present. The organization evaluates and communicates internal control deficiencies in a timely manner. So basically, it's all about reviewing, checking whether your internal control measures are good enough. Limitations of internal control: it cannot provide absolute assurance. Human judgment in decision making can be faulty. See, internal controls are still implemented by people. So people's decisions can still be wrong. Breakdowns can occur because of human errors. Management may be able to override internal controls. This is one of the risks. What is it? Even though policies are there, procedures are defined, sometimes management might say, no, we will take a shortcut. Let's not do this. We'll bypass this procedure because urgency, because of that issue, this issue. Let's bypass the processes. So management might override the internal controls. Through collusion, management, other personnel or third parties may be able to circumvent internal controls. Collusion means getting together. Like I said earlier, even though you have done segregation of duties, sometimes the people might get together and they might involve in fraud. Collusion: two or more people working together to get around the controls. What internal controls can and cannot do. Internal controls can help an organization get to where it wants to go, basically to achieve the objectives. It can help an organization achieve its goals and prevent loss of resources. It can ensure reliable financial reporting. It can ensure what the organization complies with laws and regulations. It cannot provide a guarantee. They can provide only a reasonable assurance. This we have seen the 5 components. So this is what we saw now. I wanted to do the transaction and safeguarding controls also. Let's see how many slides are there. Let's finish this also and then go to the questions. Transaction control objectives. Commonly accepted transaction control objectives. See, transaction controls means ensuring when the transactions are taking place, there is no fraud. For example, purchasing. When purchasing is happening, one common risk that many organizations face, the purchasing manager might collude with the supplier, and either he may accept some gifts from the supplier for offering the supply to them, or they might manipulate the purchase price, so that this manager might get a cut, get a percentage for him. So this is what you call transaction. How are we going to avoid the fraud, chances of fraud in transactions? Right? It can happen in the sales as well. Sometimes the sales staff can collude with the customer, can partner with the customer, can show a lower price, like a discounted price on the records. But from the customer, they may charge more, where the difference is taken by the salespeople. Not so easy if you have policies and procedures in place. But if the policies and procedures are not followed, possible. So these are known as transaction related risks and frauds. So how are we going to control that? Next one, we have safeguarding control. That means safeguarding your assets. How to ensure your inventory is safe, your cash is safe, your checks are safe, your IT system is safe. That is safeguarding controls. So commonly accepted transaction control objectives are authorization. All transactions are approved by someone with authority to approve the specific transactions. Second one, completeness. All valid transactions are included in the accounting records. You don't miss anything from the accounts. Accuracy. All valid transactions are accurate, are consistent with the originating transaction data. This is where we check with the source documents. If you have done a purchase, where is the purchase order, where is the quotation, where is the delivery note, take all that and compare, check whether the numbers are okay. Validity. All recorded transactions fairly represent the economic events that occurred, lawful, and have been executed in accordance with management's authorization. Physical safeguards and security. Error handling. That means errors detected at any point in processing are promptly corrected and reported to the appropriate level of management. Segregation of duties we have seen. So all these you say transaction controls. Some authorization approvals, verifications, which we have seen already. You can read this even. Physical controls, controls over standing data. Standing data means data that you have on a permanent basis. For example, salaries of your fixed contract staff, the rates of like part-time or piecework employees, the tax rate, the deductions, what percentage. See, these are all fixed data. We will have it in a sheet. We will calculate selling price, sales tax. So this is standing data. Controls over standing data means we have to make sure nobody manipulates this. Nowadays this is all in the softwares. It's saved somewhere and things are automatically calculated. So if somebody goes to that data and if they do some manipulation into that, sometimes even you without realizing it, even an accountant not realizing it, it might change all the processes thereafter. It might change all the numbers. So we have to make sure those data are safe. Not everyone can access that data. Reconciliations. There are many reconciliations. For example, stock reconciliation. Time to time you do a physical count. Compare that with the records. Bank reconciliation. When the bank sends you the statement, you take your cash book or bank book records, compare it. Supervisory controls means somebody supervising the work. Physical safeguarding of assets against loss is now we are coming to safeguarding controls. All these were transaction controls. Now safeguarding controls. Physical safeguarding of assets against loss is an important part of a company's operations. So how do we do that? Look at these black color writings. Segregation of duties. We have seen that. Physical protection and controlled access to records and documents such as blank checks, purchase orders, passwords, and so forth. Physical protection, that means keep it in a locked cabinet, locked room, only few people have access, or you have the swipe card system or password system. Physical protection measures to restrict access, effective supervision and independent checks and verification. Physical protection, there are two types of physical control. First one, controlled access to records and documents. This is about documents. Second one, assets, restricted access to assets. For example, controlled access to records and documents means many companies might have their own server. This server might be in a locked cabinet, locked room. Not everyone has access to it. So basically, you are recording, you are safeguarding the records, some files, documents. It's all locked. Next one, restricted access to assets. Not everyone can just walk into the stores where you are keeping the raw material inventory. There is access requirements. Access to records and documents. Checks should be stored in a locked area and access to them should be limited to personnel who have responsibility for preparing checks. Purchase orders should also be prepared, pre-numbered, numbers logged as used, and access to them similarly restricted. Corporate credit cards should be kept in a locked cabinet and access to them controlled. Password access should be controlled by limiting the access granted by each employee's password. So that is access to records and documents. Access to assets, okay, for cash. When cash must be stored until it can be deposited, it should be kept in a locked, fireproof cabinet or safe under controlled access. Inventory can be a major portion of a company's assets and it is vulnerable to loss from theft, fire, and natural disasters. Inventory should be kept in a physically locked area. Requisitions for inventory should be approved by authorized personnel. What is requisition for inventory? Factories, when they want material, they send the material requisition note. So not everyone should be able to send that material requisition note. Factory manager has to approve it and send it. Then only the stores will release the material to factories. The inventory area should be monitored by a gatekeeper, or maybe now a gatekeeper plus the security cameras. Security cameras can be used. Security alarms on doors and windows can alert local police. A security guard may be employed. Regular physical inventory should be taken. Well, that's it. So what is this? We saw the internal controls. Internal controls have 5 components, 17 principles. We saw each component briefly. After that, we saw 2 types of controls. Controls on documents, transaction controls, and safeguarding controls. Safeguarding controls, we had 2. Safeguarding the documents. Next one, safeguarding the assets. Shall we see questions on this now? No, not timed exam. Review section E. Section E, multiple choice questions. Okay. Right. So we have done A and B already. First 2 units we have done. There are 23 questions in this. 11 questions in this. Safeguarding controls, there are 40 questions. A lot of questions are there, but since it's all theory, let's not do everything here. I'll do some of them in the class. The rest you can try. A company has established policies that emphasize hiring competent people and providing them with professional training. This aligns most closely with which one of the 5 major components of internal control framework. It was part of control environment, because the people is part of control environment. So hiring competent people, control environment. Which one of the following statements in regard to internal controls is not true? Control environment is the foundation for all other components, right? Control activities are the policies and procedures that help ensure the management directives are carried out. Risk assessment is the entity's identification and analysis of risks, relevant risks to the achievement of its objectives. Monitoring is a process that penalizes managers? No. Monitoring is a process where we learn from our mistakes. We learn how things are and we improve. It's not penalizing, not punishing managers. Monitoring is not that. Which one of the following auditor findings would be most likely raise a red flag about a company's internal control environment? Which one of the following auditor findings would most likely raise a red flag about a company's internal control environment? Board nominations committee selects only independent directors. Only select committees of the board have access to outside attorneys. The role of the company CEO and board chairman are separate. Company has established independent audit committee. This is the problem, all the committees should have access to attorneys, legal counsels. Not only certain committees, all the committees should have. So they say only select committees of the board have access to outside attorneys. Wrong. So much to read. You try that. Which of the following hiring procedures provides the most control over accuracy of information submitted of an employment application? Which of the following hiring procedures provides the most control over accuracy of information? Applicants are required to sign that the information on the application is true. No, people can give wrong information and still sign. Letters of recommendation that attest the applicant's character must be mailed directly to the hiring organization. Hiring organization calls the last place of employment for each finalist to verify the employment length and position held. Yes, because that's So that's something very difficult to fake. All others still people can fake. Emails, signing, copies of the transcripts, all these still chances of faking is there. But this one, you cannot fake at all. Oh, it's very, very difficult. Why? You're calling. Which of the following is not a component of internal control? Integration is not there. Which one of the following would be considered an accounting control rather than administrative control? Maintenance of control over unused checks. Must be. That is an accounting control. That's related to accounting, right? Not administrative, not operational. Which one of the following situations represents the strength of internal control for purchasing and accounts payable? Purchases. Pre-numbered receiving reports are issued randomly. Unmatched receiving reports are reviewed on an annual basis. Invoices are approved for payment by purchasing department. Vendors' invoices are matched against purchase orders and receiving reports before liability is recorded. That must be the case. Which are the following controls? Hope you understand that that is the most strength. When the invoices come, you have to compare that with the purchase orders, delivery notes, and see whether the invoice is correct, whether we are receiving the invoice for the goods that we have actually purchased. Then you record the liability, because the moment the liability is recorded, at some point payment is going to be processed. So where you have to be very careful is when the liability is being recorded. Which of the following controls would be the most appropriate means to ensure that terminated employees had been removed from the payroll? Which of the following controls would be most appropriate? Mailing checks to employees' residences. Ensure that terminated employees had been removed. Reconciling payroll and timekeeping records. Establishing computerized limit checks on payroll rates. No. Establish direct deposit procedures with the employees' banks. Reconciling the timekeeping records. Thing is this, we have to ensure when you terminate an employee, after that his salary is not processed. Further, without the employee, in the absence of employee, salary should not be processed. So what do? Payroll, when you are processing the payroll, compare with the timekeeping records. So if you have terminated an employee, his timekeeping records won't be there. So the salary will not be processed. In a well-designed internal control structure where the cashier receives remittances from the mail room, cashier should not in a well-designed post the receipts to the accounts receivable subsidiary ledger. Deposit remittances daily at a local bank. Cashier receives remittances from the mail room. The cashier should not post, because entering the transaction should be a different person. Cashier himself should not do, because then he may manipulate the transactions and he can misuse the funds. Which another too big to read? You can try that. Appropriate control over obsolete materials requires that they be determined by an approved authority to be lacking in regular usability. Carried at cost in the accounting record. Obsolete materials means what? Outdated materials, expired materials. You can't keep them in the inventory. Carried at a cost, wrong. Retained within the regular storage area, no. Stored, no. Must be this one. Determined by an approved authority to be lacking in regular usability. Who decides the material is obsolete? There must be somebody approved to do that. Why? The moment you designate something as obsolete material, we are going to throw that. We are going to remove that from the records. So if you don't have proper controls over this, sometimes while the material is good itself, Somebody might designate that as obsolete and remove that from the records. And somebody might take it home, take it for their private use. So there must be an approved authority to identify or to approve anything as obsolete. The control that would most likely ensure that payroll checks are written only for authorized amounts is periodically witness the distribution, require supervisory approval of employee time cards. That makes sense. Yeah, requires supervisory approval of employee time cards. When employee has filled the time sheets, the supervisor has to approve it. A utility company with large investment in repair vehicles would most likely implement which internal control to reduce the risk of vehicle theft or loss? Maintain vehicles in a secured location with release and return subject to approval by custodian. Systematically account for all repair work orders. Review insurance coverage for adequacy, physical inventory vehicles, and reconcile the results with the accounting records. First one, maintain the vehicles in a secured location, and release and return are subject to approval. Which of the following activities performed by a payroll clerk is a control weakness rather than control strength? Forwards the payroll register to the chief accountant for approval. Has custody of the check signature stamp machine. Prepares payroll register. Throws the paychecks on a separate payroll checking account. I don't think a payroll clerk should have the signature stamp. That's risky. The check signature stamp. That's risky, right? Because they can fake the signatures. So stamp must be kept at a higher level, at a more safer level. And in that case, segregation of duty must be applied. If she is the person writing the checks, then the stamp must not be with her. Which of the following credit approval procedures would be the basis for developing a deficiency finding for a wholesaler? Credit approval procedures would be the basis for developing a deficiency for a deficiency finding for a wholesaler. An authorized signature from the credit department denoting approval of the customer's credit is to appear on all credit sales orders. An authorized signature from the credit department. Trade credit standards are reviewed and approved by the finance committee. Salespeople are responsible for evaluating and monitoring the financial condition of the prospective and continuing customers. Customers not meeting trade credit standards are shipped merchandise on a cash on delivery basis only. Why salespeople should not evaluate the creditworthiness of customers? That has to be done by a separate team. Why salespeople anyway they want to sell more and more. So what they will do, they might tend to be lenient, be optimistic in giving credit ratings to the customers. So that's too risky. Which of the following control procedures would be the least effective in preventing frauds in which purchase orders are issued to fictitious vendors? Require that all purchases be made from authorized vendor. That is an effective control. Here they are asking what is least effective. What is the meaning of purchase orders issued to a fictitious vendor? You just create a company's letterhead, and to that company you are sending a purchase order. Not a company's letterhead. You just make a company, fictitious company. You show a purchase from that company, and from your own company you are making the checks, making the payments to that company. But actually the purchase did not happen like that. So how do we avoid that? First thing, have the authorized vendor list, registered vendors. So you don't buy from any unregistered vendors. Require that total purchase from all vendors for a month not exceeded total budgeted purchases for that month. Require contracts with all major vendors from whom production components are purchased. Require that only pre-approved vendors be paid for purchases based on actual production. Require contracts with all major vendors from whom production components are purchased. Only pre-approved vendors be paid for purchases. Authorized vendor list maintained independently of the individual placing the purchase order. Require the total purchases from all vendors for a month not exceed the total budgeted purchases for that month. No, that may be wrong. Why that may be wrong? Sometimes, like we do more production than budgeted. So you may have to purchase more than budgeted. So purchasing more than the budgeted doesn't mean that's wrong. It can be right as well. So limiting the purchase to the budgeted amount only doesn't seem to be right. Not a good control. Proper segregation of duties require that individuals who records the transaction does not compare the accounting record or the asset with the asset itself. Yeah, the reconciliation must be somebody else. Recording is different, reconciliation is different. Well, so those are some questions from this area. Practice well, read well, and again attempt all these questions. So in the next section, we will see this one, 6 FCPA and Sarbanes-Oxley external audit opinions related areas. Just a second, let me check the slides. Yes, FCPA Sarbanes-Oxley is the next area. We'll see in the next video. Thank you.